Video. Today we are going to talk about reversal chart pattern, because yesterday we talked about the continuation chart pattern. Then we'll go to the to bilateral chart pattern. Without wasting time, I told you that you have to know the chart pattern you're dealing with in a given market before making a trade, because the chart patterns will guide you on the direction of the market, whether the market is on a continuation move, the market is on a reversal move, or the market is on a bilateral move. Those are what you have to know before making any trade or before making a decision to enter any given market. Now today, without wasting time, we're going to talk about reversal chart pattern. If you haven't watched a continuation chart pattern, go and check the previous video on the continuation chart pattern. Now today we wanna talk about the reversal chart pattern. Now we are going to talk about the reversal chart pattern. With your idea or with your own understanding, reversal chart patterns are reversal. Let us define it before. Reversal chart pattern. Reversal chart pattern are chart formations. These are chart formations that signals that the ongoing trend is about to change the course or the direction. It's about to change the direction. This is what we mean by the continuation chart, reversal chart pattern. Reversal chart pattern are formations that signal that the ongoing trend is about to change direction. That are reversal chart pattern. It is very important. Reversal chart patterns are very important, and we are going to see them in our practical examples with the real-time market trends. Now, there are things you need to see for you to you need to check for you to know that this is a reversal chart pattern. What do you need to see, or what are the factors you have to consider, or what do you need to see to identify this is a reversal chart pattern? How to identify the reversal chart pattern. How do you identify a reversal chart pattern? First thing you need to know is the trend of the market. You have to know the trend of the market. Is the market downward trending or is the market upward trending? You have to know the trend of the market. And the second one, you have to know the structure of the market. I always repeat and repeat again. Structure of the market. Then the third one, what about the structure of the market? The structure of the market, for the people who don't know, the structure of the market, what is the market forming? Is it head and shoulder? Is the market forming cup and handle? Is the market forming high-low and low-high? What is the market forming? The third thing, you have to do what we call top-down analysis. Top-down analysis. What is top-down analysis? I had taught this. Top-down analysis means you start analyzing the market from the highest time frame to the lowest time frame. Let us say that mostly I always advise you start analyzing the market from the higher time frame, which is the monthly up to 1 hour, and you can consider your entry into 1 hour or 30 minutes chart, because you can see that the market is reversing on 4 hour. Now when you check the monthly time frame, the market is on a continuation move. Now they have to you have to identify key zones on all the time frame for you to ascertain that surely and greatly this market is on a downward or a upward move. That one is what you have to consider the most. The next thing you have to consider, we have considered the trend, we have considered the structure, we have considered the top-down analysis, and the next one you have to consider is to identify the key zones in the market, and this one is very important. Identifying the key zones, in the market. What are the key zones in the market? The key zones are the places where the market always react at. Where is the market always react at? And mostly it is the support and the resistance. Where is the market reacting it? Mostly the market always reverses either at the resistance or at the support. That one is for a beginner. That one is one thing I know everybody knows. We have what we call a demand zone and a supply zone. The demand zone is the support zone, and the supply zone is the resistance zone. You have to master that, and and the key zones and the market at the you have to be able, or you have to know how to identify key zones in a given market. That one is the core of the business. You have to know, and you have to know, and you have to be careful with that. Now, the fourth one, which is the last one, you have to know is the candlestick formation. Candlestick formations, and this one is very key, because when you want to know that the market is reversing at a key zone, you have to identify the candlestick formations. What are the candles forming? We have a candlestick that forms at the resistance, which shows that the market is at a reverse and it is on a downward trend. There are candlestick formation that's always form at the support. You identify the candlestick formation. What is the reaction within the market? Is the market going to break the support and continue downwards? Is the market going to break the resistance to continue upwards? Those are some things you have to know. Now, from this, we want to explain everything bit by bit, because we have to know, and we have to know how to trade a downward trading market with some practical move. After that, then we go to the real-time market analysis. We have to go to the real-time market analysis. Now, I think I will move these writings this way. Now this is, let me draw a structure for just explanation, guys, and I think that one will be good. Then we go to the real-time market formation. Now let me say this is a market, it's upward trending, and I always say that always the market will always pull back. There's no market which is always on a straight line move. The price will never be straight line in a market. Then you find the market moving this way, the market moving this way, and I always told you guys that the market is always prone to imperfection, and when the market is prone to imperfection, you have to know how to handle that given market. You can't just see a structure. You can't just see a structure, then you want to see the exact structure from that given market. Now let us say this one was a market, and this one was a market, and you can see Then let us assume that this market had something at a key zone. This market was moving at the key zone. Let us say the key zone was here. I've marked the key zone. Then this market was upward trending and it has reached a key zone. When the market reached a key zone, you check on the candlestick formation. What is the market forming? The market reacted to that key zone and started reversed and started moving downwards. Now you have to identify what is market forming. What is this market forming? You have to know what the market is forming first for you to start or to make any decision. This market was uptrending, reacted to the support, resistance, and went back. Let us say this one was our support and came back to the support. This one was our support. Then this market started reacting at this zone. Take note. If you have any question with this, you can comment down below. This is a key zone, and this market came here, reached here, tested, went back. Now, according to my opinion, this market is forming what we call head and shoulder. Head and shoulder. This is what is the market is forming. Let me name them for you for those people who are. That one is the structure. I said that you have to identify what is the market forming. The structure of the market. This one is the head. Take note because this is a very big good information. I don't love so much theory. This one is the first head. The second head, I mean. Second shoulder. Let us name it the first shoulder. This one is the first shoulder. This is the first. This is the second shoulder, and this one is the first shoulder because this one was formed first. Sorry. This one is the first shoulder. First. The first shoulder, guys. First shoulder. Now this is the first shoulder, and this one is the second shoulder. I think you get it. That one, this is the second shoulder here. Sorry. That one is the second shoulder. Now, how do you trade head and shoulder? That one is the biggest question because we were talking about the market reversal market chart pattern. I mean, now this is take it this from me. The way we said that. Let me remove this. The way we said that first you identify your key zones, and we have identified the key zones. First you identify the trend of the market. I said you identify the trend of the market, and I had already identified the trend of the market, as you can see. Then the next thing you do is identify the structure. We have said the structure of this market is an head and shoulder, and it has formed head and shoulder. Then the third thing you have to know is you have to do top-down analysis and identifying key zones. Now this is let us identify the key zones in this given market. We have identified the support and resistance. This is head, which is the support. This is the resistance. Now this is the first shoulder, and this is the second shoulder. Now what you do, we come and mark our neckline. Because we have now a shoulder. You come here, mark your neckline. Now this is our neckline. This is our neckline. You can name it neckline. Then this is our support. This is our support. Then the head is the resistance. I know you're following very well. Now, how do you enter this given market? You wait for this neckline to be broken. For you to enter this market, wait for the neckline to be broken. Then you enter at the retest of the neckline, or the neckline maybe cannot be retested. Just enter when this neckline is broken. And what are the candlestick formation you check? Just check a bearish momentum candle when it is on a downward trend. When it is reversing on an upward trend, you check at the bullish momentum candle. Now this market has broken this neckline. When the market breaks the neckline, you target back to the support. Always target your profit should be back to the support, of which it is not all guaranteed, but there is a portion of it. Because of yesterday, I even trained you on how to take your profit from this given chart. Now let me say this one was your knee, this one was your neckline. After the neckline was your entry, and this one is your resistance. And your stop loss, you should put your stop loss some pips above the neckline, above the head. I mean, let me say this one will be your SL. SL is the stop loss. And now you want to look at the support. You want to look at the take profit. How will you take profit from here? You measure from the head up to the entry point, which is how many pips? It is 122 pips. How many pips are guaranteed as take profit? Because that one is 122 pips. You come measure from the entry, which is the entry is here. Measure 122 pips, 122 pips, 122 pips. No, sorry. Let me measure it again. We have 122 pips. 117, 122 is somewhere here. Yes, you can measure there, and 122 pips is somewhere here. Now this is the guaranteed take profit. This is the guaranteed take profit. You come here. Let us note it as TP. Let us note it at TP. This is the take profit. And yesterday I told you even how to. I told you that stop loss you should measure 20 to 50 pips above the head. That one is the stop loss. And the stop loss, normally when the market reverses against you by 50 pips, consider that market as a reversal and consider to exit that given market, because that market has changed direction. Now this is how we traded this reversal market. This market formed head and shoulder as it reacted to the resistance, broke the neckline, and we entered at the break of the neckline, measured from head to the neckline. That one was 122 pips, and we entered our trade from here. This is a sure bet up to here. That one our guaranteed take profit. And I told you guys this is how you take your profit in this given market. Now there are some candles. What are the candles you need to identify? Candles to identify at the reversal points. Those candles will direct you and will tell you that candlestick formation to be identified. Candlestick formation indicating a reversal. Indicating a reversal in a market. Reversal in a market. And this is very key, guys. Candlestick formation indicating a reversal in a market. This is very key, and you know that. Sorry, guys. This is very key. The candles which form uh, uh, at a reversal point. You have to know them very well. The first candle we always have is called the hammer. We'll identify them as we talk about the candlestick formation pattern. And we have the inverse hammer. Inverse hammer. You can go and research them, or you comment down below so that I can do a video on the same. We have dark cloud cover. Dark cloud. Dark cloud cover, which is always formed at the resistance. Dark cloud cover. We have the piercing line, which always signifies a potential reversal on the upward trend. Dark cloud cover always shows that the market is reversing to the downward, is reversing to a bearish momentum. We have what we call piercing line. Piercing line. Piercing line always signifies a bullish reversal. It shows that the market is upward trending. The market is reversing to an upward trend. Another thing we have what we call a bullish pin bar. A bullish pin bar, the name suggests, bullish pin bar. And also we have a bearish pin bar. Then the common one, we have both bearish and bullish engulfing candle, which is the common one and everybody knows. And we have what we call a morning star. A morning star. Morning star. A morning star is always formed at the support, which signifies a reversal on the bullish momentum. We have a morning star. Then we have another candle, which is the evening star. The evening star is always formed at the resistance, suggesting that the market is about to reverse to the downward or in a bearish momentum. We have the evening star. Then we have what we call a shooting star, always formed at the resistance. We have what we call a shooting star. Then we have what we call spinning top. These all are reversal candles. 3 black cows. All these are always formed at the resistance. All these candlestick formation, not at the resistance, at a reversal of any given market. They are always formed at a reversal of any given market. After identifying the structure of the market, top-down analysis, always identify the candlestick formation on the given market. Identify the candlestick formation on the given market. Now let us take a market and we check on that given market, the movement of that given market. Well, the movement of that given market. We check the movement. We just want to identify the reversal points on that given market. And we check what is that market forming. Cut CHF, which we were to analyze. Now, what I want us to know today is the reversal points in the market. And let me mark the reversal points in the market. And we said that what you have to know, this market is moving sideways. and you have to know what are the turning points. The turning points are the reversal points in the given market, what are support and what are the resistance. Now this one we are in practical part of it. As you can see, that one is the resistance. This market is on a channel. This market is on a channel, as you can see. Now we can mark them. I want you to mark those zones, and you see the zones. This is a zone. Zone. This is a zone. The market is hitting this zone, which means this is a key zone in the given market. This is a key zone, and this one is also a key zone. Now these are the places where the market is reacting to. Now what is the structure? What is the market forming? The market is forming a high, low, and a low high, because the market broke from here up to up. You can draw it. What the market is forming. Let us draw it. If you can see, let us have some drawings. It's forming high, low, the first point, second, high, low, this high, market reached here, which means the market is moving on a low, high, then the market moved here, and moved here again. That one is the structure of the market. So I told you have to identify the structure of the market, the key zones is here. Now which means this is a live market. There is a possibility that the market can move back to this place. The market will move back to that. There is a possibility that the market can break different support. Let us name them. We would say that this is a support. This zone, let's mark this one as a support zone. Support zone. This is a support zone, and this one, these are resistance zone. Those are two zones we have to obey in the market. This is a resistance zone. Hata kama sijaandika, but I know you can see that this is a resistance zone and this is a support zone. Now this market is on a channel, and where are the reversal points? The reversal points are here. The reversal points are here, and now what are the market forming? Let me. I told you that look at the candlestick formation, where the market. What are the type of the candles the market is forming? The first candle the market is forming. Let us look at the. We check the key zones. What's the market forming? You can check this. Bullish engulfing, bearish and bullish candle, bearish engulfing candle. You can see this is a bearish candle engulfing, bearish engulfing, bearish engulfing. You can see there's an indecision candle here. There's another indecision candle here, showing you that this market is about to reverse. Now these are the type of candles you have to check, and I told you you have to know where to mark your neckline. For you to mark your neckline, there's a strategy I will be teaching you on how to mark your neckline, which is not today, but today we are just talking about you have to know those candlestick formation for you to know that this market is about to reverse, and they are always at key zones. You have to check the key zones, and they are always at the key zones, and you know very well that at the key zones, when the market shows a given candlestick which I gave you, go and check those candlesticks. Those are the candlesticks showing reversal at a key zones. And if you want us to do those candlestick formations, you can comment down below there so that we do one. Thank you, and that one was my time.